half of businesses apply for finance and expect to get it in a week, 1 week. Whereas if you're applying to a bank, they will take 4, 5, 6 or even 8 weeks to decide. So it's no good going to them if you need the money in a week. They simply will not give you the finance. And if you do come across as having good financial management, you'll not only impress the bank or the other finance provider, you'll impress your customers and your suppliers. Because if you haven't got good financial management, you won't be paying your bills on time and you won't be getting the money in quickly. So good financial management pays wider dividends. Right. If you do decide you need finance, there are some basic questions you must be able to answer before you even think about where you go for finance. How much do you want to raise? Is it for short or long-term purposes? Is it for working capital? Is it to grow the business? Or is it simply to keep the business afloat? Are you prepared to offer security? That could be like buying an asset and you offer security on the asset. Or are you prepared to take in an outside shareholder? Is the business attractive to an outside shareholder? So these are the sorts of questions you need to answer before you even start thinking about finance. Right, if you leave here with one message today, I want you to understand the difference between equity finance and debt finance. Now, equity finance is where you sell a share in the business. It's not money the finance provider is expecting you to repay. What they want is a steady stream of profits, dividends, and ultimately they want to be able to sell their shares at a profit. If you're buying in a public company, that's easily done on an open market. If it's a private company, selling shares is much more difficult. Growth businesses often require equity finance because debt finance is too difficult to get. Right, with debt finance, the major issue is security or personal guarantee. If you don't offer a security or a personal guarantee, the debt is unsecured. And I want people to understand what a personal guarantee is. A personal guarantee means that you are personally liable for the debts. So if the business goes bad and cannot repay the debts, they may come on you and ask you to realise some assets. It could be your house, it could be your car, to repay the loan. That is a personal guarantee, and it shouldn't be entered into lightly. Right. I've listed there most of the main types of finance. And for startup and early stage businesses, it's the first 5 or 6 there are the ones that are relevant to you. Most businesses put some of their own money, business people put some of their own money into the business. That's known as having skin in the game. Very often they get finance from friends and family. If you've got a relative who's run a business, very often they'll be prepared to lend you money or buy a share in the business. But you must put the agreement in writing. It's the quickest way to lose friends and relatives is to have some money, put some money into your business, and then the business goes bad or you need more money and you have a dispute with the relative. I've mentioned something about credit unions and community development finance associations. These are for people who are credit impaired. They've got a bad credit history. They can help in those situations. If you've got a bad credit history, the banks and the main sources of finance won't touch you. So those two are good sources of finance for people with a poor credit history. Startup loans is a new scheme started by the government. Basically, you can get a personal loan for 5 years from a government agency, maximum 25,000, but a typical loan is about 5,000. So if you're starting a business, a startup loan is a great idea. It's a new innovation. I'll touch on the other finance schemes in a minute. And the business risk profile matters. If you've got a poor credit history, that means you're a bad risk to a bank. So if you've got a poor credit history, you've got to think, what are the alternatives? So that's part of your business risk profile. And the credit reference agencies will have information on you, and your bank will have information on you, which will be circulated to other credit providers, finance providers. Right, now let's look at specific types of finance. There are the 4 types of finance you can normally get from a bank. Either a bank loan or an overdraft, and most banks have factoring and discounting subsidiaries. With factoring and discounting, what you're basically doing is selling invoices, your sales invoices, in return for an advance on getting paid. With one, the customer will know that you factored the goods because it's the factor who chases the debt. In the other one, the customer doesn't know because you continue to be chasing for the debt. The other types of debt finance are hire purchase and leasing. Hire purchasing and leasing has become very popular in the last few years, quite simply because it's lending against an asset. Now that could be a car, it could be a computer, it could be anything that's got a second-hand value. You can raise money against it. So leasing and hire purchase have become very popular. And then a mortgage. If you're buying a business property, a mortgage is a usual way to finance it. However, the most you'll ever likely get from a finance provider will be 70% of the value that they put on the premises. So you have to find at least 30% of the value. And then I've listed the 4 main types of equity finance. Friends and family and startup finance. Then we get into small-scale equity with business angels. Business angels are people who've made a success of a business, made a lot of money, and they're looking to reinvest some of the money in a high-growth business. So what they want is to see evidence that the business is capable of growing very rapidly. And then you get onto the big stuff, venture capital. Venture capital is for businesses that want at least £2 million in equity finance, and they will want a stake in the business as a result. There are now 30 so-called challenger banks. These are banks who've started fairly recently and are now growing, and many of them are looking to provide finance to smaller businesses. Handelsbanken has been around a long time. It was formed in 1800 sometime, but it's a Swedish bank. It came over to the UK, I think, in the 1920s, but it is growing rapidly because it still does local banking and it's good on relationships. It is quite choosy about the customers it takes. But there are, as I say, now reckoned to be 30 challenger banks, all vying for business that would normally have gone to the big 5. Right. Internet finance or peer-to-peer lending or crowdfunding has become very, very popular with the media in the last few years. From there being no providers of this finance 3 years ago, in the current year, 2014, they are going to lend £1.7 billion. Next year, they reckon they're going to lend £4.4 billion. And they are a serious competitor to the banks. But there are an awful lot of them. there are reckoned to be 90 internet finance providers. So you have to know which type of finance you want to secure and which one to go to. I've looked at peer-to-peer lending at Funding Circle, and they require certain information. They want historic accounts for 2 years, must be a limited company, although I think they've changed that now to accept sole traders as well. And they require profit history and preferably some profit projections. The advantage they give is that they give a quick response. I said earlier on the banks take 4 to 6 weeks to decide. With Funding Circle, you will get a reply to your application within 2 days. 2 days, you will know whether they've accepted you for listing. Once they accept you, you go on to a marketplace, and their funders, or the crowd, will bid to lend you money. So if you're looking for £50,000, a lender might offer you £1,000 at 15%. And what tends to happen as the bidding proceeds, over the period that the auction is live, the interest rate comes down. And the average interest rate paid on peer-to-peer lending is something like 8%. So people tend to start off high, but as the bidding proceeds, it drops. When the bidding reaches the figure that the applicant looks for, he can either close the auction at that stage or leave it open for up to a fortnight to see if the interest rate comes down any further. If the bidding fails to reach the specified target, all the money is repaid to the people who've offered the finance, and the bid is unsuccessful. Once the bidding is finished and the loan is secured, the platform then operates as the intermediary between the lenders and the business securing the money. So if interest payments will go to the platform and then on to the lenders. If the business repays the loan, it'll go through to the platform and then back to the lenders. I've listed there some of the larger peer-to-peer lenders. But as I say, there are 90 of these, so there are more coming every day. I've listed there some of the advantages over bank finance, and one of them is flexibility. The other is you get a speedy response, and that can be invaluable. The disadvantage is you probably are paying a little more for the loan, but it has its advantages. They've only been around for 3 years, so therefore what you're getting is that they've got very few bad debts. It'll be interesting to see how they manage once the economy turns and they get more bad debts. Some of them are building up a fund to protect lenders against bad debts, but by no means all of them. So if you're lending through peer-to-peer platforms, you've got to make sure that there is some reserve there to pay your bad debts. Equity funding, where you're buying shares in the business, is much more heavily regulated because it's much more heavily regulated. So the Financial Conduct Authority look very closely at these sort of bids. There's a lot more paperwork involved, and there has to be due diligence, which is another level of detail. It's the same sort of principle. Again, people are bidding to buy shares, and they may bid for 1,000 shares or 2,000 shares. And again, if the total is not reached, the money is repaid straight away. And it's only when the auction is complete that is the transaction finalized. And again, the platform is the intermediary between the people who've provided the money and the business. And I've listed there a few equity finance providers. There are tax breaks for investing in peer-to-peer lending and crowdfunding. But as I say, with the shares, the research suggests that startup and early stage businesses around 50 to 70% fail. So it is a very risky investment, which is why the Financial Conduct Authority are so interested in it. You can also get working capital through the internet. And again, I mentioned factors and invoice discounters early. There's now an internet version of that. The beauty with the internet is people are much more flexible. So where with conventional factoring and discounting, they want your whole sales ledger. With these people, the top two will take one invoice. It has to be a credit-worthy customer, so if you only occasionally want to borrow, this might be, and you've got good credit-worthy customers, this might be a good mechanism for borrowing the money. You can also get finance through your credit card. If you're a business-to-consumer company and a lot of your sales are via credit card finance, and the example I give is a public house. If it's got a restaurant, people tend to pay by credit card. So the companies like Boost will look at your credit card income and decide how much they can lend you, and then you repay the loan over 7 or 8 months by deductions from your credit card income. It's again another flexible way. It's an alternative to bank finance. And there are even systems now that will do your customer invoicing for you, will manage your sales ledger, will chase the customers for payment, and then provide you with the finance. So again, another version of a conventional system. As I say, the Financial Conduct Authority took over regulation on the 1st of April of the sector. Established standards, and there are concerns that if they're too strict, the growth that I mentioned right at the beginning will die. But a very recent development, only the last couple of weeks, we've now got platforms who people can go on and they will steer people to the appropriate form of internet finance. And I think this is a real growth area. Rather than going straight to one platform, you go to one like Nurture Money, and they will point you to the source of finance that is probably most appropriate for your needs. Right, just a couple of words about banks. We can't ignore them altogether because they still do the main finance providers for SMEs. There is a system, and this is very few people know about this, it's called the appeal system. If you refuse credit by a bank, you can say you've got to have the refusal in writing, which most banks do anyway. You then say, I wish to appeal, and a completely separate team within the bank will look again at your appeal. And it is completely separate, they're quite independent of the original decision. You also should get offers to referrals to other sources of finance. As I say, all the major banks have signed up to this deal. The key thing is, in the first 2 years of this scheme operating, 40%, that's 4 in 10 of the appeals were successful. People got the money, and it's still underutilized. So if you are refused credit by a bank, it is always worth appealing. Could be quite successful. And I've put there a website that you can refer to. Just a word on the British Business Bank. The British Business Bank is a government organisation set up. It's not a bank as you or I would understand it, despite its name, because it lends to lenders. It doesn't lend directly to the public. But it has provided, it's provided money, for example, to Funding Circle to lend on to smaller businesses. One of the things I do is I sit on a committee called the British Bankers Association Business Finance Roundtable. We do quarterly research, and they produce something called the SME Finance Monitor. And one of the things that comes out of the research is only 10% of businesses seeking an overdraft and 20% of businesses seeking a loan get external financial advice before they apply. And fundamentally, what other research shows us, half of all first-time applicants for an overdraft or a loan to a bank get turned down. And you've got to wonder why that more of them don't take advice. And the answer is a lot of them just simply don't know that accountants can help them with profit forecasts, cash flow forecasts, business plans, all the stuff you need to prepare for an application. And so think about accountants if you think you need money and you don't know where to go. Just finally, a few words about our business advice service. We have a scheme called the Business Advice Service, and firms in the scheme have this logo. And what it is quite simply, you go onto our Business Advice Service website, put in your postcode, a list of firms will come up near you, and you can go and talk to them about any business problem you have. And the sorts of problems people talk to them about is, do I need to be a limited company, or could I be a sole trader? Who do I notify about starting in business? Do I have to register for VAT? All those sorts of issues you can get advice on for free. Quite simply, contact an accountant, fix a meeting, and go along. There are 4,000 of our firms in the UK providing this service, so there's a BAS advisor near you. And there's our logo, a website for where you can access this advice. Right, any questions? It's been a bit of a rush through there, but any questions? One thing I would say to you, another message I'd like you to leave with, at the bottom of the recession, there were reckoned to be 46 providers of finance in the UK, 46. We've now got 90 internet finance providers. We've got 30 challenger banks. There's an awful lot of finance providers out there. And so the key thing is deciding what type of finance you need, then looking to get the right finance for you in your stage of business. I have got some bags, but if you want some more information, our stand is just up there. So, anybody like a bag? In the bag, you will find the business finance guide. It is about debt and equity finance. I think it is slightly more orientated towards established businesses. I think that slide about sources of finance, where I mentioned the community development finance, that sort of thing, that is more for startup and early stage businesses. But do have a look at it. If you've got any queries, you know where we are on the stand. Thank you very much. Thank you.